Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Jon Mackay, Head of Platforms, U.S. Client Group at Schroders, to discuss why there is a regime change in the markets and global economy and how long it is expected to last. Jon, it's great to have you with us. Welcome to Trade Talks.
Thanks, Jill. Great to be here.
You got it. Do you believe we have entered into a regime shift in the market and global economy? And if so, what is the primary driver?
Sure, we do. We think it actually started a couple of years ago, and the primary driver is inflation. We've come out of an environment for the past 15 plus years, basically where you had no inflation. You had low economic growth globally, you had low inflation or disinflation, and you had very low interest rates. And now we're dealing with the sort of, at least in the US and a lot of countries around the world, the post-COVID hangover, a lot of fiscal stimulus, pent-up savings, pent-up demand, global supply chains that have been blocked and are becoming unblocked, but inflation that we think has become endemic to the global economy. And inflation is going to lead this regime shift in the markets. It's very different than what we've experienced for the past 15 plus years.
What about the US and EU banking systems? Is this a systemic issue or idiosyncratic to banks like Silicon Valley Bank and Credit Suisse?
We think it's systemic, and it's a tough question to answer. Banks are built on confidence, right? You lend your money overnight in a deposit, and the bank sort of hopes that you won't ask for it back the next day because they're going to lend it out over a 1 year, 5 year, 10-year period, and maybe 30 years if it's a mortgage. And generally that works when people have confidence in the banking system. They lost confidence in these particular banks because they were very niche in what they were doing, at least the ones in the US. The European issue with Credit Suisse was Credit Suisse has been effectively, I hate to say, but circling the drain for a couple of years. Major issues, a lot of scandals back in 2020. They had a big restructuring plan, but they needed time and they needed calm markets, and they just didn't get it. I think what's going on with the banks and those issues that sort of flared up with those particular banks is a symptom of the regime shift and should not become systemic. This is not 07, 08 again.
Do you think inflation is going to stay higher for longer?
We do, and part of the reason for that is you've got these secular forces that were already there before we entered COVID, but got exacerbated over the last couple of years. One of them is demographics. That's been around for a long time. It's a US issue, European issue, very problematic in Japan, as well as even countries like China. But you just don't have enough workers coming into the labor force. So you've got a shortage of labor. Supply chain issues, because of COVID, countries are talking about reshoring, onshoring, diversifying their supply chains. That creates friction in the global supply chains, which means costs go up. And then the last piece of it is decarbonization. This isn't necessarily just a feel-good story about saving the planet and stopping climate change. It's also about energy security and energy safety, and Russia invading Ukraine last year sort of put that into stark effect. Those three things we think will be with us for a long time, and that means inflation stays higher for a longer period of time.
Has the risk for recession gone up?
We think it has, and we think the risk of recession was always there. As the Fed tightened policy here in the US, and you've seen the ECB, the Bank of England, even the Bank of Japan looking to tighten policy because of higher inflation, that was going to crimp demand. The bank issues in the US and the bank issues in Europe, we think will tighten bank lending standards. And that sort of accelerates the oncoming recession, we think, which will happen in the US. Still a mild recession because the health of the US consumer is still pretty good. We do think a recession is going to happen, and what's going on with the banks will just accelerate that process.
And finally, Jon, where do you see longer term opportunities and why?
Sure, it's a great question, and I'll get back to the regime shift point I was making earlier. So very different macroeconomic environment, which means the winners of the past 10 to 15 years, the winners in a low inflation, low growth, and low interest rate environment may not be the winners going forward. So we see those opportunities in areas like international equities, we think can do well in the environment going forward. Mid and small cap US equities can do better than large cap equities. They've really struggled over the last 15 years, and we think for a variety of factors they can do better. Commodities will make sense in an inflationary environment, probably one of the best inflation hedges you can have. And then last, and this is going to sound a little fluffy, but you just need better active management and fixed income because there's going to be more interest rate volatility. You can't just hug a benchmark going forward.
All right, Jon, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.